Imagine waking up one morning to find that the stock market, worth trillions of dollars, has lost nearly half its value overnight. Portfolios that people spent decades building vanish in days. Companies once valued at billions collapse into bankruptcy, and investors are left asking the same haunting question: how did we not see this coming? The truth is, history doesn't repeat itself, but it often rhymes. And right now, investment, we're standing in what could be the largest bubble in stock market history. The signs are everywhere, yet most people either can't see them or worse, choose to ignore them. ChatGPT said, "The story of how we reached this point in the market is one that stretches back over the past decade and a half, and it is impossible to separate it from the role that cheap money and easy credit played in shaping today's valuations." After the financial crisis of 2008, central banks around the world slashed interest rates to near zero in an effort to revive economic growth. The idea was simple: when borrowing costs are cheap, businesses will expand, consumers will spend more, and the economy will recover faster. In theory, it worked. But over time, this created a ripple effect far beyond what policymakers intended. Investors searching for returns quickly realized that leaving money in a savings account earning close to 0% was not an option. Bonds, which had traditionally been safe and reliable, also provided little to no return. The result was a flood of capital into the stock market. Companies benefited from this influx of money, not because they were necessarily producing more or innovating at a faster pace, but because they had access to capital at historically low costs. The growth was further fueled by record levels of government stimulus. Whenever the economy stumbled, trillions of dollars were injected into the system. While this helped avoid immediate pain, it also created an artificial sense of security. For example, when the pandemic hit, markets should have collapsed under the weight of uncertainty, unemployment, and global shutdowns. Instead, stock prices soared to record highs because of unprecedented stimulus checks, bailouts, and money printing. Investors were conditioned to believe that no matter what happened, central banks and governments would step in to prevent disaster. That belief, in turn, encouraged risk taking on a massive scale. Companies that otherwise would have never received funding suddenly had access to virtually unlimited amounts of cheap debt. Startups with no clear path to profitability could raise millions, sometimes billions, through IPOs or SPACs. Large corporations took advantage of these conditions to borrow aggressively, not just to expand operations, but often to buy back their own stock, artificially boosting share prices. This financial engineering made markets appear stronger than they really were. The rising tide lifted all boats. Regardless of whether those businesses were fundamentally sound, retail investors also played a huge role, with apps making trading as easy as tapping a screen and stimulus checks providing free capital. Millions of new investors entered the market. Many had little to no knowledge of valuation metrics, company fundamentals, or market cycles. What mattered was that prices kept going up, and in their minds, this seemed like proof that the strategy was working. In reality, it was the direct result of an environment where cheap credit and excessive liquidity made nearly every investment appear profitable, at least on the surface. Investment, another key element to this perfect storm, is the feedback loop created by low interest rates themselves. The lower rates went, the more investors were pushed into riskier assets to chase higher returns. This wasn't limited to stocks. Real estate, cryptocurrencies, and even collectibles like trading cards and watches saw massive price increases. It was all part of the same phenomenon: too much money chasing too few assets, driving valuations higher than fundamentals justified. And each time markets showed signs of weakness, central banks doubled down on the same strategies, cutting rates further or printing even more money, only reinforcing the cycle. What makes this situation so precarious is that these conditions were never meant to last forever. Cheap money was supposed to be a temporary boost, not a permanent foundation for growth. Yet, because it went on for so long, investors, businesses, and governments alike began treating it as the norm. Debt levels skyrocketed, and entire business models were built on the assumption that borrowing would always remain this cheap. When the tide finally turns, when interest rates rise, or when governments can no longer justify endless stimulus, the flaws in the system are exposed. Companies that looked unstoppable suddenly become vulnerable. Investors who chased speculative gains are left holding the bag, and entire sectors risk collapsing under the weight of their own debt. This is how bubbles form, not from one single cause, but from a chain reaction of easy policies, misplaced incentives, and human behavior. The largest bubble in stock market history didn't appear out of nowhere. It was built step by step over years of decisions that encouraged growth at any cost, while ignoring the dangers of artificially inflating asset values. The perfect storm of cheap money and easy credit gave us unprecedented highs, but it also laid the groundwork for a reckoning that could rival anything we've seen before. ChatGPT said, "Investment, at the core of every major financial bubble lies not only economic policy or government intervention, but also something far more powerful: human psychology. The truth is that markets are made up of people, and people are emotional creatures. When the prospect of easy money is on the table, logic and reason often take a back seat to excitement and fear of missing out. This is what's commonly referred to as irrational exuberance, and it plays a central role in inflating valuations beyond any reasonable measure. And history has shown us time and again that bubbles are not simply created by low interest rates or loose credit. They are fueled by the collective mindset of investors who begin to believe that prices will rise indefinitely. And the psychology of a bubble often starts innocently. A handful of early investors identify a genuine opportunity. They put money into it and the returns are strong. Others notice these gains and start to follow along. Slowly, demand increases, and prices begin to rise more quickly. At this point, rational analysis may still be guiding decisions, but soon something shifts. Instead of carefully evaluating companies based on fundamentals like earnings or cash flow, investors begin buying simply because everyone else is buying. The justification becomes circular. Prices are going up because people are investing, and people are investing because prices are going up. This feedback loop detaches markets from reality and sets the stage for disaster. One of the most dangerous psychological forces in this process is FOMO, the fear of missing out. Investors watch as their friends, colleagues, or even strangers on social media boast about massive gains. They see ordinary people turning small investments into life-changing sums, and suddenly sitting on the sidelines feels unbearable. That's the thought of missing the next big thing becomes more painful than the potential risk of losing money. This mindset leads people to pour money into assets they barely understand with little thought for long-term consequences. We saw this in the dot-com bubble when companies with no revenue were valued in the billions simply because they had "come" in their names. More recently, it has repeated itself with meme stocks and speculative cryptocurrencies, where enthusiasm and internet hype pushed prices to levels completely detached from fundamentals. Another critical psychological element is herd mentality. Humans are social by nature, and in uncertain situations, investment, we look to others for cues on how to behave. In the context of markets, this means that when enough people start buying a stock or asset, more and more investors follow, assuming the crowd must know something they don't. The larger the crowd grows, the more legitimate the investment appears. This creates a self-reinforcing cycle where prices rise simply because they are rising and no one wants to be left behind. But when the crowd eventually shifts direction, the stampede to the exits is just as powerful, and it can cause devastating crashes. Closely tied to this is the dangerous belief that this time is different. Each bubble in history has carried with it a narrative that justified why traditional rules no longer applied. In the 1920s, it was the promise of endless industrial growth. In the dot-com era, it was the idea that the internet had rewritten business models forever. In the years leading up to the 2008 financial crisis, it was the belief that housing prices could never fall nationwide. Today, we hear similar stories surrounding artificial intelligence, cryptocurrency, or speculative startups, that the future potential is so massive that current valuations don't matter. These narratives provide psychological comfort. Investment, allowing investors to silence the nagging doubts that normally accompany reckless decision-making. They convince themselves that the old metrics no longer apply, and in doing so, they march headfirst into dangerous territory. Investment, the problem is that markets, like human emotions, are cyclical. Optimism eventually gives way to overconfidence to greed, and greed to panic once the reality sets in. When asset prices climb too high too quickly, even the smallest shock, whether it's a change in interest rates, a disappointing earnings report, or geopolitical uncertainty, can trigger a reversal. Suddenly, the same psychology that fueled the bubble works in the opposite direction. Fear replaces greed, and investors rush to sell before prices fall further. The herd mentality flips, and the stampede toward the exit destroys wealth at a breathtaking pace. It's important to recognize that these psychological forces are not limited to amateurs or retail traders. Even seasoned professionals, hedge funds, and institutional investors are susceptible. When clients demand performance and competitors are making headlines with outsized returns, the pressure to join the frenzy becomes irresistible. No one wants to explain to their clients why they missed out on a once-in-a-lifetime opportunity. And so even the so-called experts often end up contributing to the bubble rather than resisting it. This is why understanding the psychology of irrational exuberance is crucial to identifying bubbles before they burst. When valuations seem too good to be true, when new investors flood in with no experience, and when people start insisting that the rules have changed forever, those are the moments when caution is most necessary. The largest stock market bubble in history is not just the result of policy decisions or financial engineering. It is the collective product of human emotion, unchecked optimism, and the timeless tendency of people to believe that the good times will last forever. ChatGPT said the challenge with bubbles is that they rarely announce themselves. Investment. Investors don't wake up one morning and see a sign flashing. The market is in a bubble. Instead, the signs are subtle at first, but when you know what to look for, the red flags become impossible to ignore. The largest stock market bubble in history is not an accident. It has been built brick by brick through countless signals that, when combined, paint a picture of extreme risk. These warning signs are not just statistics or isolated events. They are symptoms of a market that has lost touch with reality. One of the clearest indicators is the record high valuations we are seeing across many sectors. Price to earnings ratios, which measure how much investors are willing to pay for every dollar of profit, are at levels not seen since the dot-com boom. Companies that earn little or no profit are still commanding astronomical valuations, often higher than established profitable businesses. This kind of imbalance reveals that investors are not basing decisions on fundamentals but on speculation about future potential. The higher valuations climb, the more dangerous the fall becomes once expectations are not met. Another unmistakable sign is the sheer volume of IPOs and SPACs that flood the market during bubble periods. In recent years, we've seen countless companies rush to go public, not because they are ready or profitable, but because investor appetite is insatiable. Businesses with unproven models and mounting losses have been rewarded with billion-dollar valuations. Investors are betting on the dream of what these companies could become rather than what they are. This is eerily similar to the dot-com era, when companies with no revenue and little more than a website managed to achieve high valuations until the bubble burst and most disappeared. The rise of meme stocks is another red flag that illustrates how far markets have drifted from fundamentals. Companies that were once struggling to survive suddenly experienced explosive growth in their share prices, not because of earnings, innovation, or strategic vision, but because of internet communities banding together to buy shares en masse. This kind of coordinated speculation turns the stock market into a casino where prices are driven by momentum, hype, investment, and social media influence rather than value. While entertaining to watch, it highlights the dangerous environment investors are navigating, where perception matters more than performance. And cryptocurrencies and other speculative assets also reveal warning signs. Digital currencies, NFTs, and other highly speculative investments have skyrocketed in value, often with little to no intrinsic utility or underlying business model. Investors justify these price increases with narratives about technological revolution or decentralization, but in many cases, the fundamentals are weak or non-existent. When trillions of dollars flow into assets with no track record, it signals a market environment where rational decision-making has been sidelined in favor of chasing quick gains. Another crucial red flag is the level of debt. Corporations have borrowed more money than ever before, taking advantage of historically low interest rates. Many use this debt not to grow their businesses or innovate, but to repurchase shares, which artificially boosts earnings per share and drives stock prices higher. This makes companies look stronger than they truly are, but beneath the surface, they are more vulnerable than ever. When interest rates rise or borrowing costs increase, these businesses could find themselves unable to service their debts. Investment, setting off a chain reaction of failures. The same can be said for individual investors, many of whom are using margin accounts to borrow money and buy more stocks than they could otherwise afford. Margin debt has reached record highs. Investment, which means that if the market dips, forced selling could accelerate the downturn dramatically. This amplifies volatility and increases the likelihood of sharp corrections. In other words, the market is not only inflated but also fragile, built on leverage that magnifies both gains and losses. Investor sentiment surveys also provide clues. Time and again, research shows that when optimism reaches extremes, when the majority of investors believe prices will continue to rise without interruption, that is often the moment when markets are most vulnerable to collapse. Right now, we are seeing unprecedented levels of confidence in certain sectors, with retail investors leading the charge. This widespread belief that markets can only move upward is itself a warning sign, because historically, periods of unshakable optimism have been followed by painful corrections. All of these warning signs add up to the same conclusion: the market is operating in dangerous territory. High valuations, speculative frenzies, meme stock rallies, record IPOs, soaring debt, and extreme investor confidence are not isolated events. They are interconnected symptoms of a bubble reaching maturity. Each signal reinforces the others, creating a fragile system that looks unstoppable on the way up, but is incredibly vulnerable on the way down. What makes these signs so concerning is that they are visible to anyone who is willing to look. Investors don't need to be economists or financial analysts to see that something is off when companies without profits are valued in the billions, or when people are taking out loans to buy stocks and cryptocurrencies. And the problem is that human psychology often overrides logic. As long as prices keep climbing, many investors choose to ignore the warnings. They convince themselves that this time is different, that the old rules no longer apply, and that growth can continue forever. But history teaches us that ignoring the red flags is always costly. The largest stock market bubble in history is defined not only by its size, but by the clarity of the warning signs. They are flashing all around us, and those who fail to recognize them risk being caught in the inevitable fallout. And the challenge is not in spotting the signals, they are everywhere, but in having the discipline to act on them before it's too late. When faced with the possibility of the largest stock market bubble in history, the natural question becomes investment. What can investors actually do to protect themselves? It's easy to get caught up in the excitement when everyone else seems to be making money. But survival in investing is not about chasing every opportunity. It's about building strategies that can withstand uncertainty, volatility, and even collapse. Protecting wealth in times like these requires discipline, patience, and a willingness to go against the crowd when necessary. It starts with understanding that no market goes up forever, and that the key to long-term success is not maximizing short-term gains, but minimizing catastrophic losses. The first and most important strategy is to return to fundamentals. In a bubble environment, it's tempting to focus on momentum, hype, or speculative stories that promise massive future growth. But these are precisely the types of investments that collapse the fastest when bubbles burst. A disciplined investor instead asks, does this company generate real cash flow? Is it profitable? Investment, or at least on a clear and sustainable path toward profitability? Are its earnings growth and balance sheet strong enough to justify its current valuation? By grounding decisions in fundamentals rather than speculation, investors put themselves in a position to weather downturns. Companies with proven business models, stable earnings, and manageable debt are far more likely to survive and recover after a market correction. Diversification is another crucial element of protection. One of the biggest risks investors face during bubbles is overexposure to a single sector or asset class. During the dot-com boom, many investors put everything into technology stocks. When the bubble popped, they lost nearly everything. Similarly, in 2008, those who were overleveraged in real estate were wiped out. A diversified portfolio spreads risk across different industries, geographies, and asset types. This doesn't eliminate losses in a downturn, but it cushions the blow and provides stability. Holding a mix of stocks, bonds, real estate, and even alternative investments can prevent a portfolio from collapsing if one particular sector takes the hardest hit. A third layer of protection comes from maintaining liquidity. Too often, investors go all in on the market investment, leaving themselves with little cash to take advantage of opportunities when prices fall. Having cash reserves is like holding dry powder. It allows you to act decisively when others are forced to sell in panic. Historically, investment. The greatest fortunes are not made during the bubble years, but in the aftermath, when high-quality assets are available at deep discounts. Warren Buffett famously said that opportunities come when others are fearful. Investment, but you can only take advantage of those opportunities if you have the liquidity to do so. Cash is not wasted money in a bubble environment. It's a strategic asset that buys both security and flexibility. Resisting emotional investing is equally important. This is easier said than done because bubbles are driven by collective psychology. When everyone around you is boasting about massive gains, the temptation to join in can feel overwhelming. Emotional investing, buying because of fear of missing out or selling in panic when prices dip, is the fastest path to financial ruin. Developing the discipline to stick to a plan, even when the crowd is moving in the opposite direction, is what separates successful long-term investors from those who get caught in the cycle of boom and bust. Sometimes the best decision is to do nothing, to hold your positions, or even to sit on cash while waiting for better opportunities. Investment. Another powerful strategy is to focus on long-term horizons rather than short-term speculation. Bubbles magnify short-term thinking. Investors are constantly chasing the next big thing, the next stock that might double overnight. But these gains are often fleeting, and when the bubble bursts, the same stocks can lose 80 or 90% of their value. Long-term investing, by contrast, emphasizes compounding over decades, not weeks or months. By choosing strong businesses with durable advantages and holding them through cycles, investors insulate themselves from the inevitable volatility that bubbles create. Hedging risk is also worth considering. Investment. This doesn't mean betting against the market entirely, but rather using tools like options, gold, or defensive assets to provide balance in a portfolio. While not every investor needs to actively hedge, understanding that protection exists beyond simply buying and holding stocks can provide peace of mind. For example, defensive sectors such as healthcare or consumer staples tend to hold up better during downturns because they provide essential goods and services regardless of economic conditions. And including some of these positions in a portfolio creates natural balance. Finally, the most overlooked but vital strategy is education. The more investors understand about history, valuation metrics, and cycles, the less likely they are to fall into the traps of irrational exuberance. Markets have always experienced bubbles, and while the details change, railroads in the 1800s, dot-coms in the 2000s, cryptocurrencies, and AI today, the psychology and patterns remain strikingly similar. Learning from past crashes helps investors recognize warning signs and avoid repeating the same mistakes. Education breeds perspective, investment, and perspective breeds patience, which is the ultimate shield against financial destruction. In the end, Protecting yourself from the largest stock market bubble in history is not about timing the market perfectly or predicting the exact day it will collapse. No one can do that consistently. Instead, investment, it is about building a resilient strategy that can survive the downturns, adapt to changing conditions, and position you to thrive in the recovery that follows. By focusing on fundamentals, diversifying intelligently, keeping liquidity, resisting emotional impulses, and committing to the long term, investors not only reduce their risk, but also maximize their chances of turning future crises into opportunities. The bubble may burst, but those who prepare wisely will not only endure it, they will emerge stronger on the other side.